Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good afternoon. Thank you for making time today.
Happy to be here.
Well, of course, the U.S. Federal Reserve, as expected, has raised interest rates for the first time in over 3 years. The federal funds rate had been in the zero range since the pandemic began in March 2020. It had been since July 2019. It had been coming down. So, Professor, as expected, an increase of 25 basis points. What do you make of the decision and its impact?
Okay, well, this does represent a change in the point of view of the Fed in a lot of ways. The decision to raise the rate was near unanimous. There was only one vote against, and that was to raise the rates even higher at 0.5 percentage points. Now, the increase in the rates is probably overdue, but Fed has signaled for so long that it would start raising the rate in March that I think they decided that if they raised the rates earlier, it would have upset the market. However, the rate increases may continue and may even accelerate. Chairman Powell did not state exactly how many times he will raise the rates this year, but the dot chart that was released indicates that the rate at the end of the year, the majority said it should be around 1.75 to 2% for 2022. So that would imply an increase of 7 times through this year, including the increase that just took place. The new economic projections show that the economy is not quite as bright as what the Fed expected in December last year, the GDP growth, where they expected 4.0% last year for 2022, is now 2.8%, and growth for next year has been revised downward from 2.2% to 2.0%. However, the unemployment rate is expected to remain unchanged at 3.5%. So even though the growth is slowing down, the Fed expects the labor market to be relatively strong, but inflation was revised very much higher from 2.6% in December to 4.3% for 2022 in current projection, and inflation will be moderately higher by Fed projections both next year and 2024. So in a sense, the Fed still expects the inflation to be transitory in the medium run, but it will be higher than expected in the shorter run, and their strategy seems to be reflecting that. They're expecting the interest rates to be up very much higher this year and next year, but going down somewhat in the longer term. This also shows, I think, that the Fed is going to now emphasize the inflation aspect of their dual mandate. The Fed has the mandate to maintain maximum job creation and price stability. Arguably, until last year, the Fed was putting a lot of weight on job creation, but now I think they are signaling that from now on they will be erring toward price stability rather than job creation.
Well, it could be argued that with so much uncertainty right now with the conflict in Ukraine, some could say the Fed might err on the side of caution, but still, we're looking at, as you said, 6 more rate hikes this year, most likely. But this quantitative tightening, there's aspects to this such as the tapering we were hearing about before, reducing asset purchases and so on. Powell says all this is coming faster and sooner. What do you see happening on that front, Professor?
Well, the inflation rate at 7.5% at the last March consumer price level inflation, I think it's both the Fed inside and the financial markets think that the 7% inflation rate is too high, and it could still go up further because of the Ukraine invasion. So that makes it very crucial that the Fed try to do something to maintain the inflation rate to not go up even higher than it is right now. So that would mean not only increases in interest rates, but also bringing the quantitative tightening even further in. And I think that would spook the market even more. Now, the important decision is going to be how are they going to tighten the market. In the after the global financial crisis, they just let the bonds that the Fed has bought just mature and just slide out of the market. But will they take a harsher turn and sell those bonds, which will have a more direct effect on the market? I think that will be something that the market will be very interested in. And if the Fed is interested in tightening the market as quickly as possible, then I think there is a possibility that they will decide to sell the bonds rather than just have it go out of maturity. Korea also has a difficult problem to face if the Fed does carry out the plans as it's implied in the dot chart, and they may not. Dot chart has never been right in the past, but still, even if the Fed decides to raise the rate 6 more times, that's going to have a very difficult. That's going to mean a very difficult decision for the Bank of Korea, because I don't think Korea can stand having rate increases, 6 more increases throughout the year. If you look at the international financial market concerns about financial outflows from Korea and the exchange rate, Korea should raise the rate at the same pace as the United States. But because Korea's economy is weaker than the United States, I don't think Korea can afford to have raise the rate 6 times. And that means Korea will have to raise its rate strategically, not follow the United States every time, but skip maybe some interest rate rises, and that's going to have to be done very carefully.
Right, and it was ahead of other major economies in raising rates last year. In the equities markets, we see investors seeming to welcome the rate hike at the Fed. The S&P adding 2.25%, the Nasdaq 3.75%. Reassured, it also seems by signs of progress, perhaps in talks over Ukraine. What's the story in the global markets?
Okay, well, it was interesting to see that the market was falling until 2 p.m. That's the FOMC announcement. Then after the announcement, it rose. And the analysts are having somewhat of a difficult time explaining that. There's a lot of explanations, but they don't seem to be able to agree on a single one. A lot of people are saying that the announcement reduced uncertainty. Some other people are saying that the Fed is now placing importance on inflation rather than job creation. So in the longer term, there may be less inflation. Some people are also saying that the dot chart show that the rates will be increased 7 times. There was some speculation that perhaps the rate rise will be even more, up to 9 times. So in that sense, it was a relief. But there's no clear consensus on why the market was so optimistic about the current announcement. And then the also interesting is that the U.S. tech stocks rose, and this is usually associated with a rate fall rather than a rate rise. So again, perhaps the market overestimated how much the Fed would raise the rates this time. For Europe, the markets went up as well. That they're following the U.S. They're having some relatively good news about peace talks between Russia and Ukraine. There seems to be some hope that the negotiation will be successful. Asian markets are rising as well. Hang Seng has risen by 6.3% today, and that's partially because there's now some hope that perhaps Beijing, instead of raising interest rates, will lower it and have some stimulus measures as well, because the coronavirus situation in China is worsening and they're facing harsher lockdowns. So in order to counter that, the government may decide on an expansionary policy rather than a contractionary one.
Well, Korean stocks were strongly higher today, too. Foreign investors were buying in today, and there's a seemingly corresponding strengthening of the Korean currency. Tell us about the domestic market.
Well, the U.S. dollar, as you stated, has gotten weaker. Korean won has risen quite a bit today. The Korean won appreciated by 1.9%. It ended today at 1,211.50. Year to date, though, the won has depreciated by 1.7%. The Kospi, it was up 1.3% today, ended 2,694.51. Individuals sold, institutions and foreigners bought. but year-to-date it's still down 9.9%. Kosdaq, it was up 2.5% today, ended at 914.13. Year-to-date, so it's still down 11.9%. Similarly, with the KOSPI, individuals sold, institutions and foreigners bought.
All right, Professor, we'll leave it there for today. Thank you as always for your insights. We appreciate it.
Thank you.